Well, hello, everybody. Thanks for joining us today for our entity optimization and compensation optimization for DPC owners. I've got some great dance pop music today from our streaming app. I don't know who this is brought to you by, but if you just want to stand up in your seat, since it's really exciting to be a part of this, then you can hit your best dance move on your lunch break as you learn about entity optimization. My team always makes fun of me because I like to play music in the middle of team meetings. Just if I don't like too much silence, so thinking music is good. But all right, we'll go ahead and get into it. We got, I see, 6 of us here so far, and there are probably some other people that will join on or watch afterward as well. But thank you so much for those of you guys that have joined us. I've got with me Drew Kitchens. He is one of our client CFOs, big, strong background in tax. And we kind of took away from one of our last webinars that we really wanted to do some more deep dive into specific strategies and give you all practical advice that you could leverage within your own clinics. And then I'll just share also a little bit about Goodman CPA and what we do. Goodman CPA, our primary focus is on the direct care space. Those are people that have established direct relationships with their patients. The main place we see that is typically in the direct primary care space. But we also work with direct chiropractors, direct dental clinics, direct mental health counselors, all across the range of healthcare services where people are working to bring care directly to their patients. And our whole goal at Goodman CPA is to eliminate the financial burden off your back so you can run your business every single day without having to worry about taxes, monthly accounting, even bill pay or payroll, the headaches that you might have. We want to take those off your plate. Ultimately, at the end of the day, we want to see the direct care movement succeed. And if we can come alongside you and help provide business support so you can do that, then we're achieving our mission to help you achieve your mission. So let's dive in here, kind of talk through entity structure and reasonable compensation. This is probably one of the biggest topics and questions that we get when people are starting their direct primary care clinic, or maybe they're a couple of years in and they're paying a lot in tax. One of the first things that we can look at doing is looking at the entity structure. If you have questions at all during this webinar, there should be a comments box that you can click and send us a comment. And if you send them there, we'll answer those questions towards the end of the conversation. But as those pop up, I would love to have you guys post a comment with your question. So let's look at today. Drew's going to walk us through these first 3 slides that we have, and then we're going to look at an actual case study of how this would look in your own clinic. So Drew, I'll pass it to you, kind of talk through learning practice.
Thanks, Nate. Yeah, there's just a couple of things that we're going to be aiming to learn today. Understanding the various entity options that you have, kind of what you'll default to when you first create that PLLC, and then what we tend to see as being most advantageous for most DPC owners or direct care owners. How self-employment tax pays into that. So self-employment tax can kind of be this big scary sounding word, but there are things that we can do to help mitigate that, and the proper structure can help make sure that you're paying the smallest amount possible. And then Nate's going to walk you through some real life examples of how these kind of concepts that we walk through would apply in a real situation. So, cool. So as Nate was talking about, we do a lot at the firm to help clients with a lot of complex tax strategies. And there's a lot of those that are cool, big, sexy, but one of the less sexy tax strategies that you need to be aware of is making sure that you're optimized correctly and your entity is structured correctly. Whenever you first start a practice, say that you're a, on the treadmill right now and you're looking to start a practice. If you went out and you formed a PLLC on day one, whether you are an individual or whether you're starting a practice with other doctors, that's gonna help decide if whether you're a Schedule C or a partnership. Right? You're going to be those things by default. Right? You start that PLLC and it's just you. You're striking out on your own, hanging out your own shingle. You'll be a Schedule C, and that's just going to be a part of your normal 1040 filing, your normal individual tax filing. It is simple, it's easy, but it does come with some tax disadvantages that we'll talk about. If you do take on another partner, You will have to file a separate tax return because if you have one or more partners, then you'll be a partnership, and that will have a lot of the same negative tax implications for professional services businesses as a Schedule C. There's other industries where a partnership makes sense, um, but what we tend to see most of our DPCs do is when they first start out, a Schedule C makes the most sense, right? They start the PLLC, they're just trying to acquire patients. They're not so concerned about the negative tax consequence because they're not very profitable in the beginning. So they're just looking for simplicity and compliance. And so, say we take a doctor, right? He starts his own practice and he has 50 patients. He's invested heavily in the practice, and so he doesn't really have a profit. A Schedule C is not going to make that much of a difference, right? It's going to be simple for him. He can perhaps do his own tax return and not have to worry about getting help with the more complicated S corp return. But then as he becomes more profitable, let's say he has $80,000 in net profit. That tends to be a good break-even spot for a lot of our folks where we can see significant savings on the self-employment tax piece. Then self-employment tax is going to become a big issue, right? On a Schedule C, same as a partnership, you're going to have to pay self-employment tax, which is 15.3% on all of your net profit, right? So that's on top of all of the income tax that you're paying, right? So you're going to pay an extra 15.3% on top of all the income tax you're paying. The IRS allows for an election called an S corp election. It's a form 2553 that your accountant or us or someone else could file for you to elect this. There's a lot of things that you can do if you miss this election that you can go back and retroactively do it with the right filings and the right attachments that you can get retroactive approval for the S corp election. And what the S corp election is you're electing that your sole owned business is now treated separately in the eyes of the IRS as a corporation. And you'll file what's known as an 1120S. And the real benefit there is this self-employment tax benefit, right? Now, instead of paying self-employment tax on all of your net income, it's only going to be on the salary that you pay yourself. So as your business grows, say that you have 250,000 in net income, instead of paying self-employment tax on that 250,000, now you're only going to pay it on what we pay you as a salary, $80,000, whatever that may be. Here at our firm, we use something called a reasonable comp study to really drive that salary down because we want to make sure it's compliant and we can back up the amount, but that we're also paying you the smallest amount that we possibly can for reduce that 15.3% that you're having to pay. And so in the case of the S corp, say you're making 250,000 and you're taking out 60 or 70,000 in salary, the way that the rest of that comes to you is through distributions. And on those distributions, there's no tax impact because you're already paying income tax on the S corp's income. The last option here is a C corporation. We don't tend to touch that too much when it comes to DPC practices. There's some fringe benefit advantages there, but for most of our 1-2 doc DPC practices, a C corporation generally doesn't make sense. A lot of people here have probably heard of double taxation. That's one of the major pitfalls of a C corporation. This corporation is going to have to pay tax itself, and then you're going to have to pay tax on all the income that you pull out, whether that's through a salary or a dividend. The S corp is only taxed once. The income on the S corp flows through without being taxed, and is taxed at the individual level. So generally for DPCs, the S corp makes the most sense, but in some multi-partner arrangements where more flexibility is needed in comp, we could look at a partnership structure as well.
Yeah, and I think the big thing that we see here, right, is in biggest mistake I will see in when somebody creates a company is let's say Drew and I are brothers and we want to go buy some land, right? And we're like, hey, we should put that land in an LLC. If your state is not a community property state, then by forming that LLC and saying, "Hey, me and Drew, actually, would be regardless because we're brothers." But if we bought that into an LLC, we would automatically be a partnership without doing anything else. We just formed an LLC, and both are 50-50 members in that LLC. We've now generated a tax compliance need to do the partnership tax return. We see this also if there's two spouses that are both doctors and they're going to start their DPC clinic together. they go and start the DPC clinic 50-50 in the LLC, and then they don't ever file a partnership return that first year. They just file on one of their Schedule Cs. And then we'll get 2 or 3 years down the road, and the IRS will send a letter and say, "Hey, you never filed your partnership return." And that's when people will say, "Hey, what's going on?" And that can be extremely costly because now you'll have a failure to file penalty. So if you are starting an LLC with your spouse or with somebody in the family that it feels like, "Hey, this is just my thing, but we're both listed on that state document," then you're going to have a partnership tax return requirement. And that's just default. The same with the Schedule C. If you start that LLC and it's just you, it's going to go on the Schedule C. If you don't even start an LLC, but you start making money for business, then you're still a Schedule C. The IRS looks at the you and the business as one and the same when you're looking at a Schedule C. So those are, I feel like, the biggest pitfalls we see when people choose an entity. And I usually give like the people that have been going through our like getting started into DPC and working through the business course, I just say the number one thing you should do is talk to an attorney, form a company, and then just start. Don't worry about electing S corp, electing C corp, if like any of that stuff. As long as it's just you, just get started. Once you start making money, then we can look at the tax strategy, get on top of it. So I want to make sure that in the midst of all the noise of the information that we're giving you today, that you don't overlook the one simple fact that if the thing that is holding you back is like, I don't know which entity to start with, just start. Because we need more folks that are ready to jump into DPC. There's lots of need out there. So get started, and then we can address the S Corp, C Corp partnership issue after you've already started making money. So don't let that be the hangup, because at any point we can go back, like Drew said, we can file some forms with the IRS. We can even do it late. Like if we miss the deadline, we can still get the S corp election by basically telling them, "I forgot." And we've had that same approval rating where every time we send that in, our clients are getting approved for an S corp. But to all that to say, don't let the noise of it distract you between choosing what you want to do. Just start, for those of you that are on the starting side.
Awesome. So as I was saying, that one of the main benefits of the S corp is the SC tax that you're able to avoid. Right. This is kind of walking through the self-employment tax exposure with each of these entity types. So the Schedule C, all net income is subject to SE tax. Right. So the biggest part of SE tax, for those of you who aren't familiar with the term SE tax, it's the same as the FICA taxes that you pay through your W-2. Right. This is what self-employed individuals, this is how they pay their Social Security, their Medicare, unemployment, all of those sorts of things. So if you're a W-2 employee, you likely see those coming out of your W-2 and your check, right? You pay the Social Security Administration, you pay Medicare tax and funding those programs. If you're self-employed, you're stuck paying both the employer and the employee part of those taxes. So that's the full 15.3%. And so on a Schedule C, you're paying the 15.3% on all of your net income. The Social Security, which makes up the highest portion of that, about 12%, will cap out at around 166,000, somewhere in that ballpark. It goes up every year. But the Medicare tax and the remaining amount, that remaining 4 to 5%, will continue no matter how much money you make. And so as your practice grows, that can grow to be some pretty substantial numbers. With an S corp, you're only paying SE tax on the salary portion, and that amount's not going to change. So your practice could be profiting around 100K, and we could pay you $65,000 a year. And from that, you would only pay self-employment tax on the $65,000 a year. And that doesn't matter if your practice skyrockets and it ends up doing 300,000 in net income, right? You're still only going to pay the self-employment tax on $65,000 a year. And so that can be super beneficial. And most professional services businesses find a lot of tax savings in electing S corp. The real kicker with an S corp is it does require action, and it does require a lot of compliance. And so most people who do have S corps work with some sort of professional in the accounting space to help them with that election process and to help them with the compliance there. Most of the people who are Schedule Cs and are doing, relatively large volume in some sort of professional service business aren't Schedule Cs because it's what's best for them. They're Schedule Cs because that's what they are by default, and there hasn't been a lot of planning and structure around what they choose. But to Nate's point, when we're working with clients, generally the main thing is just to get started, right? You have some run room there before you're going to have that self-employment tax exposure, especially when you're starting to practice and you have all the upfront investment. So generally, say if you started a practice 1/1/26, you could run your practice all year and make money, and we could still come in and do some fancy footwork with the late election statements and things like that and get you treated as an S corp for the full year, 9.9 times out of 10, right? And so while it's not a guaranteed approval, we have had a lot of success with that. And so, like Nate said, just make sure you're getting started. We can jump into the S corp when it makes sense. To the 65,000 that I mentioned on the S corp side, that we would pay you, whatever that amount tends to be, or the amount that you would pay the self-employment tax on. There's no real guidance from the IRS on what reasonable comp means. They just say that you have to pay yourself a reasonable salary for the job that you're performing. The way we handle that at our firm is let me back up. The way that it's predominantly handled in the accounting industry is a 60/40 rule. That's what I've seen most commonly in my career. That's what most of the people that I know still do. So say you make $200,000, they'll pay you $120,000 in salary, and you can take out the rest in distributions, right? So whatever your net profit is, 60% is going to be salary. 60% is therefore going to be subject to the self-employment tax, that 15.3%, and the rest is going to be through distributions, right? That's great at the lower numbers and lower profit amounts, but we found that it doesn't make a lot of sense, right? Because the reasonable salary or the fair market value of the services that you're providing to the business aren't changing necessarily as the business makes more money, right? Or as your business grows, you're adding office staff, medical assistants, NPs, other practitioners. You're adding these other people that are helping you grow, and it's not necessarily more time and more energy on your part on a daily basis that's going into this larger practice. And so that larger profit doesn't necessarily mean that we need to pay you a larger salary. We're very confident in that stance, and we have regulations and things to back up that. But the way we come to the reasonable salary is we go down to your local county and we find what are the fair market value per hour of the various tasks that you're doing, right? Because you're not spending your whole day seeing patients, right? You're also charting, you're also running a business, doing bookkeeping in some instances, running payroll. And so we find the fair market value of all those different things. And that's how we are able to not pay you necessarily the full amount that you would make as a physician, right? And be subject to the self-employment tax on that full amount, but also the hours that you're spending as a payroll clerk, as the person taking out the trash or whatever it may be. We get that full-time breakdown to make sure we're able to get that as low as possible and reduce that tax exposure.
So to take all the information and translate it to practical knowledge, I think the best thing to do is run through a couple scenarios. One I'm going to run through on this slide, but then I'll flip over and do a little whiteboard illustration to help bring this home. But let's talk about ABC DPC. This person's making $250,000 a year net income, right? After all their expenses, before they take out owner's draws, they're making $250,000. In scenario A, this is a Schedule C business owner. And in this situation, they're going to pay $27,600 in self-employment taxes. Self-employment taxes, I won't go through all the nitty gritty, but is made up of Social Security, Medicare, and additional Medicare tax. The limit is when you calculate self-employment taxes, not all the $250,000 is subject to it. It's very weird. It's only like 92% that's subject to the self-employment tax rules. And so we take that 92% of the 250, multiply it by our Social Security tax rate, Medicare tax rate, and since they're over $200,000 in income, they have this additional Medicare tax as well. What that translates to is this $27,600 of self-employment taxes. Now, let's look at the first scenario and just assume you're going to pay yourself $120,000 and elect S corp status. I still think we can get even more savings out of this, but this would be like ultra conservative or maybe that like 60-40 rule that Drew was talking about. So under this one, same scenario, same amount of income, $250,000, but we have a salary of $120,000. On that $120,000, that's what's getting the Social Security, the Medicare tax on. And so then you could pull out the other $130,000 as a distribution to yourself because you're a shareholder in the company, and none of that would be subject to self-employment tax. So therefore, we're only going to pay in this scenario $18,400. So right there, that strategy alone would save you $9,200. But I think you could take this even further. And so let me just walk you through a little bit more of this scenario. Let me see if I can share this. Add this to the stage. All right. So I'm just going to call this bountiful DPC because they're, wicked smart with their tax strategy. They've got $250,000 currently. And like we had talked about, if they just stay as is as a Schedule C, they're going to trigger this $27,600 in self-employment tax. All right. But if over here they actually decide, I'm going to be an S Corp, but this is probably the biggest differentiation when we look at DPC owners and direct care versus people that are in, aesthetics, or they're just a W-2 employee. You guys get probably blistered with offers from companies that'll pay you $200, $300, $400, $500,000 to come work at their hospital or in their clinic. Because all you will do every single day in that job is be a doctor or a bill coder, right? You're going to code all your services for insurance purposes. So every single day you are earning a salary of a doctor inside of that hospital or whatever, because you're an employee. But as soon as you start your own DPC clinic, you do some other things. You are the janitor, because most likely you're going to clean your office. You are the secretary in the beginning because you're going to answer the phone. You're going to check the mail. You're going to be the marketing person, right? And because you're not trained as a marketing person, I'm assuming most of you aren't, then because you're not trained as that marketing person, you're going to pay yourself a low amount. Like you're a marketing assistant. You're not a master of marketing. You're not a chief marketing officer. What else are you going to do? You are going to be a doctor, right? But in the very beginning, how many patients are you seeing, right? And how much of what percentage of your day is seeing patients, right? That's the most expensive part. The other thing that we'll get in there is you'll be like a office manager. Sure, am I missing something else we usually have in here?
HR, hiring and firing.
That's it. Yep. So you've got all of these job duties as a DPC owner, right? And what we do is we take a percentage of each of these. So let's say like 5% of your time is spent cleaning the office, and 25% of your time is spent answering the phone, and 10% of your time is spent doing marketing. So we've got 40% here. You probably spend 30% of your time as a doctor. So now we're up to 70%. And then let's say you're 15% and 15%. Right? So now you've got 100% of your job. But if you added all these roles together and how much you would get paid in your area for those things, you might come up with a salary of only $80,000. All right. So now let's play this scenario out where you're getting paid for the job duties that you're actually performing. Because the requirement, if we go back to the requirement from the IRS, S Corp owners must take a reasonable salary based on their duties. All right. Every day at Goodman CPA, I am not the CEO. I do so many other random things because I'm the business owner. I was just cleaning out the refrigerator right after lunch because we had staff in last week. So we had old chicken and salad, right? Like those are not job duties of the CEO. although leaders should eat last. Um, but that would bring my salary down because I'm not performing CEO duties in that percentage of my time. So if we take under this scenario that you have $250,000, and we're going to break out that income between salary, so 80K, and then 170K of distributions, right? You're just going to take this out of the company. And this is W2. Now, what we're going to end up with is on this calculation of the $80,000, you're going to have 12.4% of Social Security tax. So that's going to equal $9,920. You're going to have 2.9% Medicare tax. So that's going to equal $2,320. And then the additional Medicare tax is not going to be applicable because your salary is below that $200,000. So then total, what we'll have here is a $12,000 self-employment tax equivalent tax bill versus what we talked about before, which was 27,600 if we stayed in Schedule C versus this optimized S corp. And so by doing that, you've now saved $15,600 essentially. I'll put an approximate. So you can really maximize this, but it also matters on who you're working with and how they determine reasonable compensation. Because one, we've seen people on both sides. We've seen people that don't take a salary at all and put themselves at risk. And by doing that, we have a huge red flag. There's my flag to the IRS if you take a really low salary. But then a great flip side to this is also you want to also maximize retirement. And I see that question, I think, coming through as well. You can max out 401k contributions as an employee off of that $80,000, right? You can put your employee portion in of the 24,000 or so into that 401k as an employee. If you want to then max out the match, we just want to make sure that whatever you're putting in from a employee perspective. Let's see. Did it freeze on YouTube? There we go. We're back. There we go. Sorry, we froze up there for a second. You just want to make sure that the money you are increasing on your salary to max out that match from the employee or from the employer is not creating more self-employment taxes than it is in income taxes. So I'm going to flip back over real quick to our presentation here. And then we'll walk through some questions as well for you guys. So you've got a lot of opportunity to optimize on W2. And I think the bigger thing that we can say is making sure that you are focusing on working with someone who understands your situation as time goes on, so that when your situation changes, you can change your tax strategy at the same time. So let me add in here. Here we go. So kind of the steps to optimize. Number one, assess your practice. Map out your income, your profitability, and long-term goals. So that really looks like, hey, if you put together a budget for the year, are you going to be profitable this year? How much money are you going to make? Select the right entity. There are times where the partnership structure can make a lot of sense. And I'll show you that for the multi-partner DPC clinic. And then set up reasonable salary using industry benchmarks and define your roles. So we know that who is responsible for those specific roles that you are serving, or are you serving all of those roles? Some other tips for compliance that's really important here. Documenting, documenting. Document your decisions. So if you do an annual board meeting with maybe you or your spouse, write down, and then you could even use an AI tool to help you clarify your meeting minutes. Do a compensation study. You can use tools out there like RC reports, or you can use salary.com to document those specific duties that you do, and then put them into a specific written report that proves why you're paying yourself what you're paying. And then if you're working alongside a CPA, take it to them and ask them, hey, this is what I'm planning to do. If they come back with you, hey, you should just take, 60% distributions or 60% salary, 40% distributions just to be safe, you might want to look for somebody different because they're just giving you a blanket statement, not looking at your situation. Underpaying yourself could trigger audits. They could quickly analyze on your return how much money you made and what you took as W-2s. So if you don't have it documented, it's really important to have your records straight. Invoice, have meeting minutes, have payroll reports, have logs to document why you're doing what you're doing. I think entity choice shapes both taxes and liability. S corp can cut your SE tax when your salary is reasonable, and then document your decisions and review them annually. It's not a set it and forget it kind of thing. All right, so we got a couple questions here. I'm trying to achieve tax savings by lowering my reasonable salary amount, but I also want to max out 401k matching, which would be lower with a lower salary. We can play that out actually and show you what it would look like because there are times that it can make sense. So let me just go back to my whiteboard over here. Drew, you might have to call me out as I'm sharing this if I'm.
Yeah, while you're pulling that up, I'll jump back to David's question. You said that David's question further up said that he had.
Drew, you're currently muted if you're trying to talk, or something's not coming through. So let's look at 401k optimization. So if you're gonna pay yourself $80,000, the max that you can do if you do a 401k plus a profit share that the employer can contribute to you is going to be 25%. Oh, you guys are hearing Drew? They're saying you're coming through, Drew.
Okay, can you hear me now?
It might just be my sound, so you're good.
Okay.
Go ahead, Drew.
Yeah, I was just gonna, while you were pulling that up, I was gonna jump back to David's question, where he had asked about that he uses MSO for much of his admin and his business tasks. I would say, yeah, there's still plenty of ways to get around the 60/40 rule. The 60/40 rule is not a rule established by the IRS in any way. It wasn't something that they provided. It's just something that the industry has treated as a conservative estimate. And so 9 times out of 10, if you're using the MSO for your admin and business tasks, doing a reasonable comp study, you're still going to come out far, far better. In the example Nate gave, if we truly had a task breakdown, like the breakdown we did as an example, that probably would be a salary around like 60K. So most doctors that we work with, even those who partner with MSOs and have similar arrangements, we're still able to find a reasonable comp of around 80 to 90K, 90K being the high end. So yeah, the 60/40 rule is still, depending on the size of your practice, is still going to be far, far too steep, even if you're using an MSO. And I'll also say, we're not opposed to using something like the 60/40 rule when it makes more sense, right? The RC is only if your business is profitable enough to make that make sense, right? So we're not going to pay you $80,000 if your net profit is 50,000. If your net profit is 50,000, then we're going to resort to something like a 60/40, right? Where you're paying yourself 60% of the 50,000, right? Until we get up to the level to where the 80,000 salary makes sense. And that goes down to Joe's question. Joe, you said that you don't take a salary because your business is not profitable. That 100% makes sense. We would never tell you to make yourself or pay yourself a salary until your business has the profit to do so. One of the If you look back in the case law, one of the strategies that's been very successful in combating the IRS on this issue, when they try to challenge you on this, is the cash flow argument, right? Saying you don't have the cash flow to pay yourself a salary, right? So you're not required to pay yourself a salary at all. Even if your business is, regardless of cash flow, even if your business has 500,000 of net profit, you're not required to pay yourself a salary. You're only required to pay yourself a salary if you're taking money out of the company at all, if that makes sense. You can't take 500,000 out as a shareholder distribution, because then the IRS thinks that you're trying to um, evade self-employment tax, right? So when we say reasonable salary, we have to take that in conjunction with, we're also taking out shareholder distributions. Does that make sense, Joe and David? All right. Steven said, regarding 401k profit sharing, I have one employee. Yeah. So on the profit sharing side, that's what Nate was kind of getting into with the he was about to draw up on the board. So if we drop your salary using the reasonable comp, you can still max out the employee piece, the 24,000, right? To max out the 24,000, you only have to pay yourself 24,000, right? That just has to be a dollar for dollar comp. Now, if you have the employer side or a profit sharing arrangement or an employer match or something like that, say it's 4%, right? Your 4% employer match is going to be much smaller, right? But with the lower RC, you can get a lot of tax savings and still get, let's say, 70 to 80% of the 401k benefit you were going to get. And that can make a lot of sense to a lot of people. And so what we do for most of our clients is we get on the drawing board and we have like a spreadsheet that we'll walk you through that can show you what the break even point is for you. We have some clients that are at a different stage of life and they want to put a ton away for retirement. And so we can optimize for that, right? There's a break even point where it makes sense, where maybe you're not saving all the tax that you can, but you're saving some tax. You're not putting all you can into 401k, but you're putting a lot, and finding that break even point at what makes sense for you, right? Sometimes it's not all saving tax and it's not all putting in 401k. Um, there's a break even point that makes sense for everybody based on their goals. Um, and to Stephen's additional question about the 25%, yes, if you're going to contribute to your employee due to the IRS's rules around discrimination, you do have to match the same as your to yourself as your employees, right? So you can't have your plan predominantly benefit what the IRS calls highly compensated employees or shareholders. And so in that, if you're going to pay yourself a 25% match, you're going to need to provide that for your employee too. The one thing I would keep in mind there is the rules around that. If you're a 401k, those tend to be shorter. For a SEP IRA, you can have those extend out to a couple of years, up to 2 years, right? Where that person's not eligible in the plan for at least 2 years. I think a 401k, it's 6 months to a year, so they'd have to be with you for that period of time. You could set it to where they have to be with you for that period of time before they can participate in the plan. But yes, Stephen, you would need to also match for your employee as well. Awesome. Well, is there any additional questions? If not, we appreciate you guys. This link will go out to everyone, so you'll have you have the ability to go through and review this and um, anything. And if there's anything we can do to help you in your specific situation with your practice, don't hesitate to reach out. We love working with DPC practices, and we love what you all are doing for the industry. All right, Vincent has an additional question. Sorry, what are the costs associated with hiring a CPA? Okay, that is a wide realm, right? You have, everything down to H&R Block, right? Where you could pay someone, um, you could pay someone to set up an S corp for you. just to do the filings and compliance for you. And that's going to range. If you're going to get a decent CPA, I would expect to pay a compliance fee of around, you know, probably $2,000, $1,500, $2,000 for your business return, and around $1,000 for your personal. So anywhere from like $2,500 to $3,000 is what I would expect to pay for just your run of the mill basic CPA. Our services are a little different because what we do is we provide a hands-on approach. We'll provide you tax savings numbers. Our average client that comes in who was previously working with a CPA, if they're in the DPC space, we're familiar with the industry. We're able to help save them at least, on average, I think the average is around $30,000. That we're able to save them, the people that were previously working with the CPA, and that's from some strategies that we have. We call our workhorse strategies, and some of the strategy that we're able to provide. The difference with us is we require that our clients meet with us 4 times a year, right? So that we can make sure that these strategies are up and running. And we like to say that our team likes to do 90% of the work, right? So we're talking about all of these things you have to do, the compliance, the documentation. Our team handles all of that. We just let you know what you need to do to stay compliant, and we keep a packet for that should the IRS ever come ask. We're ready for them. Okay. Vincent, Nate, you're back. Vincent's
I'm
asking,
back.
what can we expect to pay? I just gave a kind of a primer on our services there. Vincent asked, what are the costs associated with hiring a CPA? And I explained the difference between, just a run-of-the-mill CPA, kind of the difference between what we do here. And then he had a follow-up question. What can you expect to pay to set up an S corp? If you want to jump in on some of these.
Yeah, the S corp compliance setup is that also depends on where you go. The bigger thing, you can get an S corp set up for like, I don't know, $500 or $1,000 on LegalZoom. They'll file the form for you, but you also need help with the ability to know what you should pay yourself and do the reasonable compensation compliance work. So that's another kind of big piece. That's, you can get the S corp election and like knock it out and try to DIY it. But if you're not also running the reasonable comp piece as well as the compliance to the S corp, then all they're doing is making the election. So you can get it for as cheap as like 500, $1,000. You can get it as expensive as like $5,000. That's somebody who's hopefully going to also help you set up maybe payroll to go with it, so you're paying yourself. But yeah, it can be a wide gamut. With us, when we do it, we just include it as a part of our people's fee for their annual fee. And our fees work very similar to DPC. We charge monthly. People then can reach out to us when they have questions whenever. That way, we found the same with DPC is our clients end up in a better financial and tax position when we remove all barriers to access. So, Robert, I'll share this other slide with you guys that just has our contact information as well. And for you, Lisa, yes, we work with clients in all 50 states. If you're in New York or California, those are just more fun states to be in. But
Yep.
we're happy to help people in any state.
We have clients in those states, but your tax jurisdiction, your tax Department of Revenue is sometimes difficult to work with. And then Paul, to Paul's question, yes, we do have, I think, I have to go back and look. I think we have 6 or 7 counseling practices that we currently work with under our model.
Yeah. The other piece, so you try looking into profit sharing plans through 7 different companies like Guideline, and a few others, but because I'm younger than some of the provider employees, it doesn't make sense. Is there any alternative for this solution? We decided to stick with Safe Harbor. Madeline, it depends on how you guys have set up your practice and the other people within your practice, but you are going to get hung up on age-based profit sharing. There is something that you could look into that it's another type of profit sharing. The way you set it up is it's basically unconditional. Like you will contribute to all employees regardless of if they contribute to their plan. You can then do a similar safe harbor 401k without without having it being based on age as one of the criteria. And that can help you get around the age based, but you're still going to contribute to everybody's within a profit sharing model. And that's something people will say is like, oh, well, I want to get the most for me. Because you can do a profit share based on compensation too. It doesn't have to be based on age. It can be, hey, we spent, $500,000 on payroll this year, so we're going to do a profit share of 50,000. You have 50% of the pool, then you could get pro rata a profit share based on that. So there are some alternatives for that situation. Guidelines not going to be your option because they don't do um, that specific type of profit sharing. Betterment might be another solution for you. They will get a little bit more complex with how they set up their 401ks and profit share. But if you want to shoot me an email, Madeline, I can also connect you with like an employment-based financial planner that will help you set up a more complex 401k with profit sharing. So, at what point would it be a good idea to start looking to hire a CPA? 4 months into my clinic, just around break even, having to pay off loans. Yeah, totally get that. Um, so monthly fees for us are based off of the size of the clinic, the complexity of your tax plan, and what you're needing from us, right? I think the best thing to do, we customize our quotes. I try to work with folks that are, in the starting phases to find a plan that works for them. So I think the best thing would be to, talk offline about what it would look like to work together and what you're needing. It is an investment to prepare yourself as you grow. And so looking at it as, hey, is this the next thing for my company to be able to, grow and succeed? Monthly fee, we do have a monthly fee that includes monthly accounting. We don't call it bookkeeping because most of our accountants are a little higher level than a bookkeeper, but we do the monthly transaction work similar to a bookkeeper. Is there flexibility? 100%. We try to find what works for you, so you guys aren't stuck in a plan that you don't want or don't need. My goal is at the end of the day to help people in this direct care space succeed. And so if our fee is keeping you from succeeding, then what are we doing here? Drew, did I miss anything else while my computer was utterly
I
shutting
think
down?
I think we got them all. I think that's it. If you do have any questions, if we missed one, or if you guys think of anything else, feel free to give us a shout. This email address here.
I
Thanks,
don't know
guys.
if Steven, did you Steven's conversation on the 25% max?
Yeah, I got that one.
Do you talk about SEPs? One
Yeah,
with that option? Because like with the other option for Steven is like with an SEP, depending on how old your clinic is, you could do a SEP IRA instead of a 401k. SEPs have this 3-year like requirement for employment that you could set up. So you technically could put 25% of your salary into an SEP for 3 years until that employee would become eligible. It's a great way to kind of front load your retirement before that employee, becomes eligible in a plan. Then you could set up a 401k.
yep. You're also not required to continue the 25% SEP contributions once the employee becomes eligible, if it doesn't make financial sense.
I think, Paul, I don't know if you finished my conversation on going through. There is a time when maxing out your salary is better and it's worth it to take the FICA tax hit than it is to drop your salary as low as possible. You can do, and just tell me, Drew, if I'm duplicating what you've already said, but
That's okay, man. Yeah, I answered all of these, but you're good. Maybe you have some extra nuggets in there.
what I thought was really interesting about that question is basically the idea is like lowering your salary is not always the answer, right? The IRS won't complain if you pay yourself more and pay more in FICA taxes. But you could maximize your salary, so taking as much as possible in W-2s. And if you are ready to put $250,000 into a retirement account, then if you're in like the 40% tax bracket, it's going to make sense to maximize your salary. And you could put your money in what's called a cash balance plan. And we might have a whole nother session on cash balance plans. But by doing that, you could push $250,000 into the future so you're not paying tax on it today via that cash balance plan, which is another super interesting way in helping you understand that no, it's not always the answer to reduce your salary, right? If we're trying to maximize the 401k, let's just make sure you're not paying more in FICA taxes than you would be in income taxes to get that money into the retirement account, because that will never make sense. So I say always work with your accountant, your CPA. They should be bringing you these ideas to help you save on taxes. Just like my own DPC doctor, when I go see him, because he knows me, he brings opportunity ideas of how that I can, help my health get a little bit better. Maybe I should lay off the brownies at night. Things like that. That they're actually invested in that. The similar to us, we're invested in our clients' success because we are working with you all year long. So cool. If you guys have any questions, like Drew said, get in contact with us here. We offer free strategy sessions, basically where we look at your situation, figure out what you might be able to save in taxes, and we analyze your tax return to say, hey, maybe you missed out on $30,000 in taxes. Here's what we could do to help address that, and what it would look like for us to work together. So if that's interesting to you, would be happy to help. Hopefully this was helpful today. If you guys have something you would like to see, please shoot us an email. You can also shoot me an email directly, which is just nate@goodmancpa.com or .llc. They both get us to the same place. And you say, hey, I'd really like to hear about this specific topic. We'd love to address it and bring you some good information. So thanks, everybody. Have an excellent, Wednesday, the 12th. So thanks, guys.
Thanks.